Welcome to our CFP exam prep discussion today, where we're diving deep into short selling, a crucial concept that frequently appears on the exam and often causes confusion among test takers. Let's break down short selling from its core. Short selling is a trading strategy where investors borrow shares from a broker and sell them immediately, hoping to repurchase them later at a lower price. The profit comes from the difference between the selling price and the lower repurchase price. Understanding the mechanics is essential for the exam. When you short sell, you're borrowing shares through your margin account. This is a critical point that test takers often miss. You absolutely must have a margin account to short sell, as regular cash accounts won't allow this type of transaction. Here's the process that you need to memorize. First, you borrow the shares from your broker. Then, you sell these borrowed shares at the current market price. Later, you buy back the same number of shares, hopefully at a lower price, to return them to the broker. This buying back is called covering your short position. Many candidates make the mistake of thinking there's no risk limit in short selling. This is dangerously incorrect. While losses in traditional buying can only go to zero, losses in short selling can theoretically be infinite because there's no ceiling on how high a stock price can rise. The exam loves to test this concept. Another common exam trap involves dividends. When you short a stock, you're responsible for paying any dividends to the lender of the shares. For example, if you short 100 shares of a stock that pays a $2 dividend, you'll need to pay $200 to the lender. This is a detail that frequently appears in exam questions. The margin requirements for short selling are more stringent than regular margin purchases. You need to maintain additional margin requirements due to the unlimited risk potential. The exam often tests scenarios where market movements trigger margin calls in short positions. Here's a practical example that mirrors what you might see on the exam. Let's say you short 100 shares of XYZ stock at $50 per share, receiving $5,000. If the stock drops to $40, you can buy it back for $4,000, making a $1,000 profit. However, if the stock rises to $60, you'll lose $1,000 if you cover your position then. One of the biggest mistakes test takers make is confusing short selling with buying put options. While both are bearish strategies, they have very different risk profiles and requirements. Short selling has unlimited risk and requires paying dividends, while put options have limited risk and no dividend obligations. Remember to watch out for questions about the uptick rule, which requires short sales to be executed at a price higher than the previous trade price during periods of significant market decline. This regulation detail often appears in exam questions, but is frequently overlooked during preparation. To succeed on short selling questions, always consider the margin requirements, dividend obligations, and unlimited risk potential. Pay special attention to questions that mix these elements together, as they're designed to test your comprehensive understanding of the concept. When you encounter short selling questions on the exam, take a moment to identify whether they're testing the mechanics, the risks, or the regulatory requirements. This approach will help you avoid common pitfalls and select the correct answer more consistently.